Hello. Have you ever wondered how a market can exist that is several times larger than the entire global economy, and yet remains almost invisible to ordinary people? Today we are going to talk about derivatives, about a market with a volume of around $700 trillion, which Warren Buffett called financial weapons of mass destruction. You will learn how these instruments once already collapsed the global financial system, why they did not disappear after that, and what could become the trigger for the next crisis. In the year 2002, the most successful investor on the planet wrote a letter to the shareholders of his company. In that letter, there was a phrase that would go down in history. Derivatives are financial weapons of mass destruction. They carry dangers that, while now hidden, are potentially lethal. This was said by Warren Buffett, the Oracle of Omaha, a man who turned $10,000 into more than $100 billion. A man who makes mistakes less often than anyone else on Wall Street. And he called derivatives a time bomb, both for those who trade them and for the entire economic system. 6 years after that letter, the global financial system collapsed. The reason? Derivatives. The very same financial instruments that Buffett warned about. But the story did not end in the year 2008. It was only beginning. Today, the notional value of derivatives on the over-the-counter market reaches approximately $700 trillion. This is not a typo. 700 trillion. For comparison, total global gross domestic product is around 105 trillion. That means the derivatives market is 7 times larger than the entire world economy. And here is the main question. Was Buffett right? Are we facing a new explosion? Before being frightened by the numbers, let us understand what this actually is. The word derivative comes from the English word derive, meaning to produce or to derive. A derivative is a contract whose value is derived from something else, a stock, a bond, an interest rate, a currency exchange rate, the price of oil, or even the weather. Imagine that you are a farmer growing wheat. The harvest will be in half a year. You do not know what the price will be, maybe $100 per ton, maybe 50. You are afraid. Then a buyer comes and says, "Let us agree now. In half a year, I will buy your wheat for $75 per ton, no matter what happens." This is a futures contract, one of the simplest derivatives. You have fixed the price. If the market falls to 50, you win. If it rises to 100, you lose, but you sleep peacefully. Sounds reasonable, right? This is called hedging, insurance against risk. But then people realized, why own wheat at all? You can simply bet on its price. If I think wheat will rise, I buy a futures contract. If it will fall, I sell. I do not need fields or harvesters. I only need a computer and some money. Thus, derivatives turned from a tool of insurance into a tool of speculation, into a casino for Wall Street. Then, financial geniuses invented even more complex things. Options, the right but not the obligation to buy or sell. Swaps, the exchange of cash flows. Credit default swaps, insurance against a borrower's default. And here is where the magic begins, or rather the madness. Imagine that I can buy insurance on the fact that your neighbor will not pay his mortgage. I'm not a bank, I did not lend him money, I do not even know him. But I can bet money on the fact that he will go bankrupt. Moreover, an infinite number of insurance policies can be bought on the same debt. It is as if 100 people insured one house against fire, and all of them would get paid if the house burned down. Buffett wrote about this as follows: "The range of derivative contracts is limited only by the imagination of man, or, as it sometimes seems, by the imagination of a madman. To understand how dangerous derivatives are, let us begin with the story of one man. His name was Nick Leeson. In the year 1992, he was 25 years old, and Barings Bank, the oldest merchant bank in Britain, founded in the year 1762, and sent him to Singapore to run trading on the local exchange. Barings financed the purchase of Louisiana, the wars with Napoleon, and the construction of the Erie Canal. Even Queen Elizabeth II held an account there. Leeson was supposed to engage in arbitrage, buying futures on the Japanese Nikkei index in Singapore and selling them in Osaka, earning a tiny difference in prices. A virtually risk-free operation. But Leeson began to place bets. He believed the Japanese market would rise. When the bets lost, he doubled down. This is called the martingale strategy. If you lose, bet twice as much. Sooner or later you win and recover everything. The problem is that sooner or later, the money runs out. By the year 1993, Leeson's losses amounted to £23 million. He hid them in a special account numbered 88,888, the error account. By the end of 1994, they had already reached 208 million. Then, on the 17th of January 1995, an earthquake struck Kobe. The Japanese market collapsed. The Nikkei fell by 1,000 points. What did Leeson do? He doubled the bet. Again and again. By February 1995, He controlled 49% of all open positions in March futures on the Nikkei and 85% of positions in Japanese government bonds. Other traders saw his enormous positions and began trading against him. On the 23rd of February, Leeson left a note saying, "I am sorry," and fled. 3 days later, Barings, a bank with a 233-year history, was declared bankrupt. Losses amounted to £827 million, twice the entire capital of the bank. ING bought Barings for a symbolic £1. One person, one account. Derivatives and 233 years of history turned to dust. Barings was a rehearsal. The main performance took place in the year 2008. Do you remember credit default swaps? Insurance against default? In the year 2000, their market was worth around $900 billion. By the year 2008, it wound from 33 to 47 trillion. Growth by 50 times in 8 years. How did this happen? In the year 1997, the head of the Federal Reserve, Alan Greenspan, fought to keep the derivatives market unregulated. In the year 2000, Congress passed a law that prohibited regulation of over-the-counter derivatives. Completely. No oversight, no transparency, do whatever you want, and the banks did. They began packaging unreliable mortgage loans into complex securities, collateralized debt obligations. Then they sold insurance on these securities, credit default swaps. Rating agencies assigned this junk the highest AAA rating. Investors around the world bought it. Then housing prices began to fall. People stopped paying their mortgages. Collateralized debt obligations lost value. And all of those insurance policies, trillions of dollars, had to be paid out. Who sold the most insurance? American International Group, the largest insurance company in the world. American International Group sold credit default swaps worth $500 billion. When the market collapsed, the company did not have the money to pay. On the 16th of September 2008, the Federal Reserve was forced to rescue American International Group with a loan of $85 billion. Then more and more. The total amount of assistance exceeded $180 billion. One day earlier, on the 15th of September, Lehman Brothers, one of the largest investment banks in America, went bankrupt. Lehman had $600 billion in debt. Of those, $400 billion were insured with credit default swaps. Remember, an infinite number of insurance policies can be bought on one debt. When Lehman collapsed, everyone who had sold these swaps had to pay. A chain reaction. Nobel Prize laureate Joseph Stiglitz described it this way: with such a complex web of gigantic bets, no one could be sure of anyone's financial position, or even of their own. It is not surprising that credit markets froze. The global financial system stood on the brink of collapse. Governments around the world poured more than $14 trillion into banks. Taxpayers' money. Buffett was right. Derivatives truly became weapons of mass destruction. After the year 2008, the world promised to change. Leaders of the Group of 20 met in Pittsburgh in the year 2009 and agreed on reforms: transparency, central clearing, reporting. In the United States, the Dodd-Frank Act was adopted. In Europe, the EMIR regulation. And some things did change. Now, most standard derivatives pass through central clearinghouses. Banks are required to hold more capital. There is at least some reporting. But the market not only did not shrink, it grew. In the year 2008, the notional value of over-the-counter derivatives was around $683 trillion. By the end of the year 2024, around $700 trillion. The market that nearly destroyed the global economy became even larger. Yes, the gross market value. The real money that would change hands is much smaller, around $17 trillion. But even that is 10 times more than it was in the year 2000. And here is what matters. Most of the risks did not disappear. They were simply moved. Before, people feared that large banks were too big to fail. Now the same problems exist with central clearinghouses. If one of them collapses, the consequences will be catastrophic. The International Monetary Fund warns that connections between banks and non-bank financial institutions, hedge funds, insurance companies, pension funds, have only intensified. According to estimates, American and European banks have $4.5 trillion of exposure to the non-bank sector. And this exposure is largely hidden, because most non-bank institutions are regulated much more weakly. But do you know what is most ironic? Warren Buffett, the man who called derivatives weapons of mass destruction, actively uses them himself, and he earned billions from them. From the year 2004 to the year 2008, Berkshire Hathaway sold put options worth $4.9 billion. Buffett bet that global markets would grow in the long term. During the crisis of the year 2008, the value of these options rose above $10 billion. On paper, Buffett was losing enormous sums, but he could afford to wait. And in the end, he won. This is the main secret of derivatives. They work for those who can afford to lose, for those who have enough capital to survive any storm, Buffett explained. To get a counterparty for such a transaction, you need impeccable credit quality. When people hear the words Berkshire Hathaway, they think of conservatism and a high credit rating. An ordinary person cannot play this game. An ordinary bank can, but risks going bankrupt. And Berkshire Hathaway receives billions in premiums for promising to pay if the market collapses, knowing that in the long run the market always grows. Derivatives are a casino where the house always wins. Only the house is not Las Vegas. It is Goldman Sachs, JP Morgan, the Lockheed Martin of the financial world. 5 largest banks control the overwhelming majority of the derivatives market. They set the rules. They know each other's positions. They trade with each other. And when something goes wrong, they are rescued. Because they are too big to fail. Every crisis begins with excessive debt. In the year 1929, it was margin loans. In the year 2008, it was mortgage lending. Today, United States government debt has exceeded $33 trillion. Interest payments on it reached $933 billion in the year 2025, more than the entire defense budget. And the derivatives market, $700 trillion in notional value, ties everything together. Banks, insurance companies, pension funds, hedge funds, all are intertwined by contracts that few people understand. In its Global Financial Stability Report for the year 2025, the International Monetary Fund warns that a sharp drop in asset prices or a rise in bond yields could create pressure on bank balance sheets and open investment funds. The interconnectedness between banks and non-bank financial institutions will only amplify the transmission of shocks throughout the financial system. What could become the trigger? Geopolitical escalation, the collapse of a major counterparty, a banking panic, a sharp correction in mega-cap stocks, a political mistake that undermines trust. When, not if, but when, the next crisis arrives, derivatives will once again be at the center. Because they are what bind the entire system together, and because they turn a local problem into a global catastrophe. As one researcher wrote, the derivatives market is enormous in notional value. A counterparty failure can cascade in ways that are difficult to model. Let us summarize. In the year 2002, Warren Buffett called derivatives financial weapons of mass destruction. 6 years later, they nearly destroyed the global economy. One man, Nick Leeson, bankrupted a 233-year-old bank. One instrument, credit default swaps, collapsed the largest financial institutions on the planet and required trillions of dollars in taxpayer assistance. Today, the derivatives market reaches $700 trillion, 7 times larger than global gross domestic product. The system has become even more interconnected. Risks have moved, but they have not disappeared. Buffett wrote, "The derivatives genie is now out of the bottle, and these instruments will almost certainly multiply in variety and number until some event makes their toxicity clear." The year 2008 made that toxicity clear, but the genie is still free, and the bottle is broken forever. The question is not whether Buffett was right. He was right. The question is when the weapon will fire again.